tips in targeting the right position for you, and give you some demographic information and some ideas on how to target that search to find the right position. A lot of people, when they get out and practice, they ask us about incorporating a dental professional corporation. So I'm going to talk about the process and when it's appropriate to incorporate, and go through a case study of a dentist who graduated from university. And then I'm going to show you a sort of a timeline and go through some scenarios. And integrated with that, we're going to look at the utilization and mechanics of the tax credit system in Canada, and how those tax credits get applied, and how that sort of integrates in with the decision to incorporate a professional corporation. Quick dental accounting 101. I'm going to give a quick outline of some of the revenues and expenses that are involved in the management of a dental clinic, and sort of forward-looking type, and just a quick little tip on some dental accounting fundamentals. As well, we're going to look at, for those of you that are looking at associating this year, or your new associates, or even those of you that are still have been associating for a while, we're going to look at what are some of the deductions that you can deduct against your income, so that you can mitigate your tax burden. And we're going to go through some of the categories and show you an example of some of the worksheets that we provide to our clients. We're going to give I'm going to give a brief summary on the tax-free savings account mechanism for those of you that want an update on that, as well as a registered retirement savings plan. A quick 101 on the latest updates on how that program works, and when it's appropriate to integrate that into your tax planning. For those of you that are looking to purchase a property, we're going to give a quick update on the home buyers plan, how that works, and look at some tips on when it makes sense to use that program to purchase your first home, as well as a first-time home buyers tax credit, which is a tax credit that's available to first-time home buyers through the federal government as a byproduct of your tax return. It's a mechanic of your tax return. I'm going to go through some tips on that. And for those of you that are recently graduated, I'm going to talk about how much income you can expect to make in the first year, second year, and also after that, depending on where you decide to practice and what structure you use. Also going to look at when you should start looking for a practice to buy, and some tips on if you're looking to buy a practice or start up a practice, some of the tips on some things to consider in that process. So a lot to cover. It's going to be pretty quick, though. I'm going to go through everything pretty quickly, but hopefully if you have some questions along the way, you can use the chat, and you can always reach out. So Chapter 1, Dental Economic and Jobs Update. So I used this slide in a previous session that I did. And I'm just going to see here, put the laser on. So this is, the current state of affairs. It's a dashboard that I actually pulled out from the World Health Organization. It was dated June 23rd. And it currently shows that, what's interesting thing about this, it shows that there's 8,993,659 cases of COVID-19 currently. And when I pulled the slide from another event that I was doing in June, it shows that there's 6,194,533 cases on June, I think it was June 4th. So in 20 days, it's gone from 6.1 to 8.9. So the cases are definitely increasing exponentially globally. So this is where we're at, and this is part of the new normal. Now, in terms of the employment picture, this is a graph from Stats Canada, and it shows you the level of employment, unemployment levels from 1981 to April of 2020. And the gray areas are the recessionary periods in that time. So the bottom axis is the time line, and then the axis, percentage axis here is the percentage of the unemployment. So, for example, in 1981 to 1992, the gray areas are the recessionary periods. And the second recession was in 1990 to 1992. So there was a longer prolonged recession during that time. So it was a few more longer period. And then there was another recession in 2008 and 2009, which was coined as the Great Recession. And now again, we're in a recessionary period starting now in March of 2020, based on the definition of 3 consecutive quarters of negative GDP growth. So as you can see, the unemployment level obviously spiked in March and April, primarily because of the Great Lockdown period, which resulted in a lot of people being sort of laid off and you know, temporarily through the fact that everybody was locked down. So what I thought was interesting thing about this is you'll notice is that in the other years, the peak of the unemployment didn't actually spike until later on in the recession. For example, in 1981 and 1982, the unemployment level was, you know, at the beginning was maybe at 7%, and it peaked up to 13%, but it didn't happen until later on in the recession as things progressed and sort of things deteriorated. The same thing happened in 1990 to 1992. It didn't actually get up to 12% until later along the way. So, and similarly in 2008 to 2009, same kind of thing. It wasn't until later on in the recession that the unemployment rate went from 6% to 9%. So in this particular case, I'm pretty sure, I mean, this first spike was the lockdown effect. So it should moderate over time as we go through the next quarter, but it's something that definitely needs to be monitored as we go through the next quarter in determining where do we reach that equilibrium where the unemployment rate sort of normalized without the lockdown provisions. But the pain of a recession through economic cycles typically increases the unemployment rate. Now, I expect the unemployment rate is not going to stay at 13% because a lot of that is temporary, and it may shoot back down to maybe 8, 9, 10% over time, but then it may still spike back up. So we have to kind of expect that. Now, in terms of the current unemployment rates during the lockdown period, no province or territory for that matter was unscathed here. So it was pretty much a national effect in Canada, globally, as well as the United States. So now this shows you a breakdown of the different industries in healthcare and how the unemployment essentially was affected in the different sectors. So the red line is hospitals. So hospitals were relatively flatlined in terms of the number of unemployment, the number of workers that were unemployed didn't really spike up too much because the hospitals remained open, and that was where most of the concern was in terms of the medical sort of or reorganization. In terms of nursing and residential care facilities, they're also pretty much flatlined. It was the ambulatory healthcare services, which includes dentistry, as well as other medical and health-related services, which are not part of the hospital system. And obviously, they had the spike from February, March, April, and May, primarily because of the fact that there was a lockdown, and a lot of the non-emergency services, such as dentistry, were restricted through the regulatory framework. For example, the RCDSO requirements. So something, that's a general trend in terms of what's happening in terms of the macroeconomic. Now, in terms of those of you that are looking to find a position in this higher unemployment environment, one of the concepts that we brought up in an earlier webinar was modern chaos theory, and modern chaos theory is really a concept which is best explained, I think, in the concept of weather patterns and how they're so difficult to predict and globally, and it's a point of chaos. But within chaos, there's also a point of creativity and growth that can come out of that. So you need to, for those of you looking for a position, an associate position, and haven't found one yet, you need to use your network and identify this as a market opportunity. It gives you an opening really to go out there and be a little bit more proactive in trying to reach out to dentists that are dental owners and saying, hey, you know, I'm here to reach out and maybe lend a hand to them and open up your network in maybe a different way than you would have if it was just a regular everyday economy, because you can sort of reach out and say, hey, you know, how are things going, and get some market information. Find a mentor in terms of a practice owner, or even a dental colleague or somebody that you know, and leverage that relationship to help you find a position. Start a study club or join a study club or a local society, and use that as a network, part of leveraging your network to find that additional associate position, or it could be your first associate position. And maintain flexibility in your options on what you're looking to do in terms of your career and your career search during the process. And look at demographics in terms of, and I'm going to get into this a little later, in terms of what kind of, where you're looking for that job, and where is that, what kind of county or province are you looking at, and what are the demographics of that area, and how many dentists are in that area. And maybe be creative in terms of your search and use different ways and avenues of looking for a position that you may not have thought of through the old traditional way. You know, you might look at a classified ad, or you might send a letter, but now maybe you want to use social media, or you want to use LinkedIn, or you want to use different ways of, you know, reaching out that you wouldn't have considered in a normal economic cycle. So now that you've you know, you've got all these economic problems, so a lot of associates now are sort of like, okay, well, or a lot of students who sort of have to make a decision on what to do. Some people have decided to maybe do a GPR. So that's also a trend that we're seeing, where a lot of people are considering maybe doing a one-year general practice residency in the United States or Canada, and applying for that, especially because there's some uncertainty as to how the demand for dentistry is going to play out over the next 6, 12, 18 months. And, you know, it's a hospital-based practicum, but it gives you that extra year to get some more experience. So that's definitely a trend that we're seeing, as well as the AGD, the Advanced Education in General Dentistry, which is available in the United States, to give you that other bump in terms of exposure to other aspects of dentistry, such as perio, prosto, TMJ, surgeries, advanced surgeries, implant dentistry, and advanced treatment planning techniques. So that's something we've seen a trend of, and that could be something that more people may consider in the next cycle. You know, right now we're in June of 2020, so you know, a lot of these programs are taking applications now, so there could be a bigger demand for that kind of stuff now. So definitely want to look into that going forward if you think that you're going to have a delay in finding the right associate position. For those of you that are associating, I mean, obviously that's the third option, right? So instead of doing the GPR or the AGD, you can go straight into the associate position. And that's what most people do, and it's great because you get immediate work experience and you start accumulating some return on your educational investment into dental school. So I just put together a quick summary of some of the things that you want to consider when you're looking for that associate position. So one of the things is a split. Basically, how are you getting paid? Are you going to be an employee? Are you going to be an independent contractor? How much are you going to be paid, and how are you going to be paid? And that's one of the things you need to ask the principal when you're negotiating that, or you're having that initial meeting and you're negotiating a contract. You may be asked to sign an agreement. You need to review that agreement and make sure you understand the mechanics of it. One of the other things, mentorship. Ask the the principal whether what kind of mentorship can you expect? Do they have senior associates on staff? Are they willing to train you to do certain things in the dental industry and connect you to their network? Look at what the associate history is at that clinic. Was this a newly created position? Is this something that they have a history of training people and then moving on, or is this a long-term opportunity? Ask the seller, not the seller, but the principal dentist, what is the succession opportunity here in the long term? Because it's always nice if you can find a position where you have an opportunity to potentially maybe buy the practice, or maybe partner with the principal dentist. So you can ask these questions as part of the discovery process when you're looking for a position. In the agreement, there may be certain clauses, like a competition clause or a radius clause, which talks about certain limitations that will come into effect where in the situation where you leave the practice and you go to another office, and there may be restrictions in the agreement. So we do recommend a legal review being done. We do work with dental law firms throughout the country that specialize in the dental industry. So we recommend an independent legal review and ILA, independent legal advice, be obtained by yourself before you sign an agreement, just to make sure that the clauses in the agreement are favorable to you, and there's nothing in there that's going to prohibit you from starting your own practice or finding another associate position in that same area and that kind of thing. And the restrictions, if any, that are put into the agreement are reasonable. Continue education. You can ask the principal if they will be supporting you for any of your continuing education courses throughout the arrangement. Patient records. Who owns the records? There might be some information clauses in the agreement talking about that. Vacation time. Look at what are the stipulations of vacations, taking vacations, taking time off. Do you have to ask in advance? That kind of thing. If there's any non-solicitation provisions in the agreement, and your lawyer will advise you on that. Essentially, what that means is if any of the if you leave the practice, that you cannot go and contact the staff or the patients after the fact to try and get them to come work with you, or get the patients to come work at your clinic, for example. And there's restrictions in the agreement for that. Profit share. There are possibilities as things pre-COVID, it was getting very competitive for associates, and a lot of practice owners were looking for associates, and they wanted to find the right person, and they were offering them incentives. So it doesn't hurt to ask. It's not necessarily the best economic environment for that, but at the same time, people are still running their business, and they need access to people that know how to perform the services that are required to keep the office running efficiently. The terms of the agreement. How long is the agreement? Is it 1 year? Is it 3 years? Is it renew? So these are things to look into. Termination of the contract. What happens when you leave? What happens? Do you have to give them notice? That kind of thing. You'll see that you may see that in an agreement. What's the culture of the office? The staff. Check out the website and see if there's any perks in terms of access to possibly dentistry for your free dentistry for your family members, or social events and that kind of thing. Look at the structure of the office. What is their copay situation? Do they have assignment, non-assignment? That'll give you an idea of sort of the management of the office and how it runs, as well as the front desk and the hygiene department. How does it work? What are the administrative policies? And you could get a tour of the clinic and find out these things. And that can give you a good idea of what you're basically leading yourself into that new opportunity. A lot of times when you're looking at an interview, sometimes you are being interviewed, but you also have to interview the principal and ask them questions. So for those of you out there that just graduated looking for a position, these are just some high-level tips. And hopefully as you go through the process, you can cross them off the list. So in terms of back to this sort of, and this is, the economic environment that we're in, I had posted this slide in a previous presentation, and I just wanted to speak about it again. And what it talks about is the different ways that the economy will recover. The job market will recover as well. And economists have different ways of explaining that. And there's the V-shaped recovery, the U-shaped recovery, the L-shaped recovery, and the W-shaped recovery. So in this particular slide here, this particular section, they talk about the V-shaped recovery. And they're using an example of what happened in Canada in 2008 and 2009. And what had happened was the economy went down, and then it sort of went right back up. And that was because the government had put in economic stimulus into the economy and injected cash into the economy to help it recover quickly. So that's known as a V-shaped recovery. So it sort of goes down and then just right back up again. In the United States, during the same time, they sort of had a U-shaped recovery. So it took a little bit longer for them to recover, because in 2008 and 2009, they were hit with a little bit more of a real estate adjustment, where they had a subprime mortgage lending adjustment that they had to deal with. And there was some financial instrument issues to Wall Street that had created problems. So it took them a little longer to get out of that weaker period. So that's sort of the U-shaped, where it sort of comes, sort of comes into the recession period, it goes down, and it sort of takes a while for it to recover. So that's sort of like the U-shaped recovery. And then the L-shaped recovery, like in Greece, for example, where the economy was humming along, because they had a lot of problems in sovereign debt issues, in terms of the country itself was having major issues in terms of handling the pension funds, and the cities were going bankrupt, and a lot of the pensioners were were no longer getting their checks. So there's fundamental structural issues. So they had sort of gone down, and they continued to go down, sort of an L shape. So it's sort of down and then flatlining across, and it took them longer to recover because they didn't have the ammunition available to them in terms of economic monetary policy to inject money back into their economy, so it took them longer to recover. In this particular case, with the COVID-19 issue, we're looking at more, I think, of a W-shaped recovery, where it's going to be a little bit more erratic in terms of up and down, depending on the epidemiology of the virus and how things progress through, and the job market may be the same. So there might be some inconsistency in the growth that we have. We're clearly going to have some sort of rebound quickly, but it may look like a V-shaped recovery initially, but depending on the second wave of the virus and the epidemiology and the vaccine and the therapies associated with COVID-19, we may end up with a little bit more volatility in terms of the economic outlook. So that's something to monitor as well in your job search. So this is another trend that we're seeing, and this is some information that came out of the American Dental Association recently, and they're saying that in the United States, some of the data that's coming out of there is talking about the layoffs and are hitting the employee dentists or the associates a lot harder than some of the other staff. And that's definitely something to monitor. And in this particular area, you see here, it says, non-owner dentist, are you being paid this week? So in the United States, most of the states opened up in the beginning of May, whereas in Ontario, for example, we opened up in the first week of June. But so they have a little bit more information. But up to the first week of June, 1 month after opening, they still had 17.7% of the associates essentially still not working. So, and 36.1% of them, they were still being partially paid. So there seemed like a little bit of a slower recovery for some of the associates. So that's definitely something to monitor, and a trend that we're going to be talking about later on as well. Now, this one here looks at the weekly patient volume and the collections in the United States. Keep in mind, they have a lot more data coming in. And somewhat positive, 53% of pre-COVID levels in terms of patient volume, and that's about 4 weeks in to into the U.S. And so they were at 18% pre-COVID capacity, 38%, 53%. So the number of the patient volumes have increased up to about 50%. So that's a good sign, and that's the weighted average. Some offices were seeing 76 or more percent recovery of their pre-COVID capacity. So and that was about 30% of the survey size. So, you know, in Canada, we're seeing something similar. We're only about the 3rd week in here as well. But from the feedback that we're getting from our clients, is a lot of the patients are coming back and rebooking, and we're not sure if that's just pent up demand or a recovery that's going to be expected long term. This looks at the this chart looks at the different economic employment numbers of how things went sort of down in dentistry, for example, and then they've popped back up to about 70%. So a lot of the employment levels have gotten back up to about 70% of pre-COVID numbers, which is a pretty good bounce back, and that includes all front desk assistants, associates, and all. And it was down to about 44% in the sort of the lockdown period. But now the other areas, in terms of doctors and other healthcare practices, they didn't see as much of a dip because they weren't prohibited by some of the lockdown provision and guidelines by their colleges. So it's interesting to see how there has been a positive uptick, and we're expecting that to continue as we get through the summer. So this is another example of the similar statistic about the independent contractor dentists, and how we're seeing that some of them are still not being engaged back in the clinic. This is interesting because they talked about the appointment schedule, and 31% of the practices are already showing a full schedule into week 3, and this is out of the United States. And we're seeing similar things happening in Canada, similar trends as we start opening up. And in Ontario, it's been a little bit slower than some of the other provinces, but as things start opening up and people start getting more comfortable going back to the regular routine, we're expecting the schedules and appointments also to book back up. This is a statistic that came out of a dental service organization in the United States, and they were looking at patient visits. So the patient visits were traditionally at 23,124. This was a dental service organization in the U.S. that has about 800 offices. So they were pre-COVID, they're at 23,124 patient visits, and they dropped down to 3,308 in the in sort of the trough of the lockdown period, and they've bounced back up to about 16,000 patient visits, you know, about a month in. So you can see how there is a recovery happening in the market. It's just going to take some time to get back up to the pre-COVID levels. This is also a similar statistic where it shows you the red line here is the average dental treatments going back from pre-COVID, and you can see how there was a dip down of the number of weekly volume of treatments during March and April, and now it's popped back up to 59.1% of pre-COVID levels, and it's projected to continue to increase to 75% of pre-COVID levels. So there is a pretty good bounce back happening in the United States, and they have a lot of data coming out of there, so we're using that as a pretty good benchmark as to how things are going to proceed in Canada as well. This is also another company that is in the United States, but they have been, they provide practice management software, so they have a lot of data available, and they've shown similar trends where pre-COVID things were flatlining in terms of it was healthy in terms of the dental production, things dropped down, and things have sort of popped back up 60, 70, 80%. And this in terms of production and as well as patient visits. So that shows you some information coming into a very large population of data out of the United States, and a very similar, we're expecting very similar things to happen in Canada. Now, back to the job search. So that was sort of, the previous stuff was just sort of the economic outlook, gave you some quick tips on associate ideas, as well as the macroeconomic picture in terms of the job market. Now, in terms of job trends, possible reduction in hiring on new associates. So there is a possibility that a lot of smaller practices who were hiring associates for that additional demand may decide now to not hire the associates, and the principal may go on and start doing the work themselves, or they might lag the return of those associates, similar to what we saw in the United States. So that is something that may affect the new associate market negatively in the next few months. More part-time positions is something also we may likely see as things start rebounding and people start remeasuring the amount of activity available. There will probably be more part-time positions as opposed to full-time positions. And that's something that we've seen a trend of anyways, where most dental associates will work at multiple offices. So they may be scheduled on, Monday, Wednesday, Friday at one clinic, and Tuesday, Thursday, Saturday at another clinic. And that's just been typically what we've seen it hasn't been abnormal to seeing that, but it may just become more part-time positions where instead of the 3 days a week, you may be doing 2 days a week, that kind of thing. We are expecting an increase in the number of dental practices being listed for sale because there was a 3 or 4 month delay in the practices that were listed for sale because of the lockdown. It's also possible that that the number of people that are looking to get out of the industry, who are maybe more senior in the industry, may put their practice up for sale once things start to recover. And we're expecting to see an increase in that. We're also expecting to see an increase in new clinics because a lot of associates who were working full-time, or maybe they had 3 different places they're working at, for example, part-time, and they had a full schedule, but maybe they're seeing some reduced hours now. They may decide to open up a new clinic, or to go buy a new clinic, or buy an existing clinic, just to start their own path to their career, rather than wait and work less and be sort of, governed by the principal dentist schedule. And that's another trend that we're seeing. Also seeing more increase in specialized training, where people are going to possibly use this as an opportunity to do more continuing education, brush up on more specialized areas such as oral surgery, endo, ortho, but also something to be mindful of is that those industries are also seeing changes in the way that things are being done, particularly in orthodontics, where there's a lot more public companies, for example, that have recently popped up that provide teledentistry type services for orthodontics through mouth guards and whatnot that assist with orthodontic work. So, like, for example, there's Smile Direct Club, Align Technologies, these companies, Invisalign. That kind of trend could affect certain industries in a negative way. Oral surgery, haven't really seen much negative there. There's been pretty strong demand for oral surgeons. Endodontics, there has been further use of microscopes, and we've noticed that that's reducing the amount of root canals that are being done. So maybe a small reduction in the amount of endodontic complex work getting completed, and just being reducing the number of procedures. So just beware, I guess, on which specialization you're going to choose, and look at the trends in that area. We talked about earlier the GPR and the AEGD options. I think we're going to see more of that as well, where people might go back and just continue to invest in their education to get more hands-on training. Because if somebody's getting a couple of days a week at an associate position and they need more experience, they may just decide that's not enough for them and go and reach out to the American or Canadian organizations providing additional education. Here's an example of a couple of recent post-COVID job postings that we saw in it was in a oral health magazine, I believe, and it just talks about, just as you can see, part-time, 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 part-time. So that trend has always been there. However, we're looking at possibly seeing more of these part-time postings made available, and that could be just part of a general trend where that may just increase. Now, in terms of the job search, for those of you looking for a position, recent grads, it's important to understand the dentist to population ratio, regardless of what region you're in, whether you're in Ontario, British Columbia, Alberta, whatever province you're in. You want to reach out and find out in that particular area and region that you're targeting your search, what is the dentist to population ratio? Because that could have a dramatic effect on the demand for dentistry in that area. For example, this is a list of some different counties in the province of Ontario, and certain areas, for example, in Huron County, there's 3,104 individual residents for every dentist. Whereas in other regions, for example, here in, let's see here, Sudbury, 2,116 dentists for every, 2,116 individuals for every dentist. And if you look at other areas like the Greater Toronto area, it's even closer to like 900 to 1,000 people for every dentist. So if you're, it's not uncommon for people to go out and search out for associate positions outside of the city areas and go for the rural areas where there's a bigger demand for dentistry and there's just less dentists. So definitely something to look at when you're doing your research and targeting your search is doing some research on how many dentists are in that region and what's the population of that region. And as you can see on this chart here, for example, here in the Metro Toronto area compared to the Northern Ontario region. So number of days dentists is booked ahead over here. So you look here, in Toronto, they're booked ahead about 10.5 days. Northern Ontario, they're booked ahead 26.4 days. So that's a significant difference in the number of days they're booked ahead, depending on what region they're in. Another interesting one here is number of days hygiene is booked ahead. Metro Toronto area, 40.2 days of hygiene, they're booked ahead. Northern Ontario, 83.3. So more than double the number of hygiene days booked ahead. So that's a significant difference, and it's just the region based on the number of dentists and based on the number of population. And just the supply and demand. Annual hours worked. What's interesting here is the dentists in the Toronto region were working 1,553 hours, whereas the northern region, they're working less. So they're working less, but they have a lot more work. So that's these are trends that you need to sort of look at and think about when you're deciding where you're going to get that additional experience as an associate dentist. What's another one here? Oh, there's another one. Average hygiene hours. So in GTA, 1,007 Greater Toronto area, in the city, 1,758 average hygiene hours, 2,928 hygiene hours in Northern Ontario. So that's a significantly more hygiene work in that area. So so that sort of ends that chapter in terms of just finding an associate position, some tips on how to search for the right position, look at the demographics, look at the area, look at the dentist to population ratio in that area, use that in your search, and move on to chapter 3. When should I incorporate? Now that's a question that comes up a lot because in various different jurisdictions throughout Canada, depending on which province you're in, you can incorporate what they call a dental professional corporation. We get a lot of questions from individuals that start working. Is like, should we incorporate right away or should we wait till later, or when's the most appropriate time to do that? And I'm just going to go through some high-level decision-making tree as to when it's appropriate to do so. So when trying to understand this question, it's important to understand the different structures that are available in Canada when you are operating a business. And as an associate dentist, you are running a business. And the first structure is a sole proprietorship. So sole proprietorship means you're not incorporated, you're operating under your social insurance number, you have very limited tax, tax planning alternatives, and you're paying a high rate of tax. It says here 46.41, but actually the high rate of tax in combined high rate of tax in Ontario right now, combined with federal, is actually 53.53%. I'm going to show you more detail on that later. But you have limited options. It's a simple structure. You just file it on your personal tax return. You're paying the high rate of tax. You don't really have any income splitting opportunities, but it's a relatively straightforward and simple way to continue filing. You're just paying a high rate of tax. Now, the other option is you incorporate a dental professional corporation. So that opens up a couple of more options. You have a little bit more options in terms of income splitting. There's a little bit more flexibility. The corporation's tax rate is lower because it's eligible for what they call as a small business deduction. And that lowers the tax rate from 53.53%, the high rate, to 12.2%, which is the current rate, combined rate in Ontario and federal combined, 12.2% on any income earned less than $500,000. So there is some savings there. Now, depending on what province you're in, for example, in Ontario, you can add family members as shareholders of your professional corporation. Now, there are limitations on how you can use that to your advantage in terms of on an annual basis for income splitting purposes, but there is still an opportunity to income split with certain family members if they're involved in your practice. And in Ontario, for example, your spouse, if you're married, or your children or your parents can also be shareholders of your corporation, and you can add them on. And depending on what province you're in, you got to look at the regulatory body in that jurisdiction to see what their limitations are. So it gives you a little bit more flexibility. Now, it also adds on other layers of planning where you can incorporate maybe a second company if you're planning to buy some real estate or you're doing some investments, and there's no restrictions on that company's ownership. Whereas a professional corporation, there would be restrictions on who can own it. But it also enables for different structural tax planning opportunities depending on what you're doing in your career, buying a practice, opening a practice, and whatnot. So it allows for further advanced planning opportunities. And then here's just another example where you can have like your professional corporation here owned by the dentist, and then there's another corporation here which is operating maybe a hygiene corporation or other technical services, and it's owned by, there's no restrictions on how that particular company ownership is structured. So it just opens up some planning opportunities. In terms of the tax rates, so here's a grid, and it basically shows you there's that 53.53%. So that's the high rate of tax. So any income that you earn personally over $220,000 is taxed at 53.53%. Now, the way this grid works is the left-hand side is the income level that you're in, and this is on the personal side. So depending, as your income goes up, for example, in this case, from $42,961 to $46,000, so that approximate $4,000 gap, the marginal tax rate is 24.15%. That means for every dollar above $42,961, you're going to pay an extra 24.15 cents in tax. So this is what we call as a marginal system, because as the tax brackets increase, the marginal increase between the brackets is taxed at that rate. So to simplify it, if you're making any income over $220,000, any income over that is going to be taxed at 53.53%. And if you make $220,000, the total cumulative tax that you'll pay would be $80,000, taking into consideration all these combined marginal tax brackets. So it can be a significant tax burden when you're earning income in a sole proprietorship on your personal side. Now, The other tax rate, which is important, is what's the corporation tax debt. So the corporation tax rates have actually gone down recently. So in 2020, the corporate tax rates in Ontario and federally, for example, combined is 12.2%. So any production that you earn or collection that you earn as a dentist, less your expenses, which we'll get into later, you're paying tax at only 12.2%. So there's a significant difference between the 12.2% and the 53.53%. So there's a large gap and spread there, so we can help in reducing your tax burden. Any income over $500,000 in the corporation is taxed at 25%. But so there's still a savings there if you're a high producer. So here's a summary of the differences in the savings by using a dental professional corporation. So you get the small business tax rate, which is 12.3% on the first $500,000. Of that is actually going to be at 26.5%. It's actually 26.5% on any income earned in the corporation above 500,000. So there's a difference of 14.2% between any income earned under 500,000 and over. So that's a significant difference between the personal side, where you're looking at any income earned less than up to 145,000 is 46%, and anything over $220,000 you're at 53%. So there's a big gap between the two structures. So that's what leads into the one of the savings opportunities. Some of the other structures that I talked about earlier, you've got the opportunity to income split through salaries and dividends through the professional corporation, which is a little bit more. You can't pay a dividend through a sole proprietorship. And if you pay a dividend from the professional corporation to yourself annually of approximately $35,000, there's no federal tax. So there are other ways of mitigating your tax burden, as well as there's no CPP on dividends. So now the other inherent advantage of incorporating is you also get an eligibility for something called a lifetime capital gains exemption. And that's designed for people that sell their business. So if you sell your business and you own a dental practice and you're selling it, the current lifetime capital gains exemption, which is the concept where you don't pay any tax, capital gains tax, on the selling of your company's shares, is $883,384 of a benefit. And that could save you up to $236,000 in personal tax just by using that as a vehicle. That may not apply if you're an associate, but it could be something that's advantageous when you're in your future down in your career. Now, the tax credits that are available through your tuition play nicely into the decision on whether to incorporate or not, because a lot of times when you're studying, you're accumulating tuition credits, and those tuition credits aren't being used in your tax return because you don't have any income. But those tax credits they do carry forward. So I'm going to give you an example of something you might see. So this is an example of somebody who was in university and they went to dental school, and every year their tuition credit that they kept getting, that there's a slip that you get from the university. It's called the T2202A. They filed it with their tax return, and they accumulated $125,317 in tuition credits over their study period, including some of their undergrad. So before they started working, this is an example of somebody who was in the class of 2014, for example. So they're in class of 2014. They accumulated all these tuition credits. They graduated. They had tuition credits, and they started associating. So what happened was, they went through the same decision tree. Should I incorporate? Should I not incorporate? And because they had the tuition credits available, those credits can only be applied on your personal tax return. You can't transfer them to the corporation, for example. So in this particular case, in 2015, when they started working, they started reporting their income from their collections, from their associateship, and it was $226,000 approximately. So that was how much money they actually collected in 2015, the first year after the year after they graduated. So let's say they graduated in June. We worked a little bit the first year because it was about 5 or 6 months, and then that first full year after they had graduated, they had $226,000 approximately in collections. And they were able to deduct some expenses against that too, because they were going to courses and they had their CE and they had some travel costs and they had some supply expenses that they had to incur. So they ended up with about $170,000 of income that they had to get taxed on. So the same thing for 2016. So what happened was, because they had the tuition credit carried forward from the prior year, on their 2015 return, most of that tuition credit got applied. So the same tuition credit that was here, the $115,626 that was available to them, they used it on their 2015 return, and it reduced their tax burden quite significantly. They still had to pay $25,000 in tax, and they also made an RRSP contribution of $18,000, but it reduced their tax down to about $25,000. Then in the following year, when they did not incorporate yet, and then they had the similar amount of collections, about $253,000 in collections, and they had some expenses that they incurred, and they ended up with about $171,000 of net income. And then when they did their tax return, they had to pay $50,000 in tax. And that was even after making an RSP contribution of $25,000. So after cutting a check to the government for $50,000, then they started thinking, well, this is getting a little burdensome. And they had used all their tuition credits at that point. So then they decided, well, let's go ahead and incorporate a dental professional corporation. And they actually did that at the end of 2016. Because a lot of times what happens is the dental income starts catching up to you. And then, throughout the year, they planned on incorporating and they never did. And then when they got to the end of the year, they calculated all their collections and they're like, whoa, I'm already at $253,000 of collections. And then when they did the calculation and like, oh, I already used my tuition credit, they kind of were like, well, I don't want to keep doing it this way. Is there a better way? So then they went ahead and incorporated. This individual wanted to incorporate earlier, but they just didn't get around to it. And then eventually they did at the end of 2016. And then in 2017, they started depositing all their money directly into the corporation rather than into their personal. And they still got to deduct some of their expenses, and they applied some of their expenses. And they got to take advantage of the lower corporate tax rate. At that time, it was closer to, I think, 13%. So they were able to mitigate their tax liability by using the professional corporation as a vehicle. And this is a high level topic and subject at this point, because every circumstance depends on how much money you take out of the company, and that could be an additional layer of taxation there as well on the dividend. So it really depends not only on how much money you deposit in the company, but also how much money you take out of the company, which could be taxed secondarily as a dividend, depending on how much you take out. Now, what happens is when you incorporate, for those of you that are sort of in that process where maybe you're already associating and you want to incorporate, you also got to look at what happens next. So what happens is generally is you'll take the articles of incorporation and you go to the bank and you open up a bank account, and then you'll start depositing the checks directly in the company. We typically recommend opening up a credit card as well in the name of the company, so that you can deduct all your business expenses directly in the corporation, and it becomes a lot easier for your accounting and your record keeping if you just keep everything under a simple structure. Now, understanding the mechanics of that leads us into Dental Accounting 101. So the fundamental accounting equation: assets minus liabilities equals equity. So basically what that is what do you own, whether it's cash, real estate, could be even your loops, your laptop, your computer, supplies. You own something, minus what you owe. So things, people you owe money to, maybe OSAP, maybe your student loan, maybe your line of credit, maybe a bank loan. The difference between what you own and what you owe is your equity. That's the fundamental accounting equation. So that equation should be easily understood, and it can be applied in both on your personal side and in your business. What do you have? What do you own? Who do you owe money to? And the difference is your net worth or your equity. So that's the fundamental accounting question. And understanding that will help you and guide you through understanding the mechanics of your future accounting, which will be the running of a dental practice. This particular chart here just shows you some of the different categories of expenses that a dental office will incur. So they've got their dental income and their hygiene income, but then they have to pay for their professional fees, their accounting, their bookkeeping, their licensing fees, their insurance, their rent, their repairs, their utilities. So it just gives you a nice breakdown of the different categories of expenses that are deductible and need to be considered when you're running a business. Now, as an associate, it's a little bit, you may not have some of those expenses. Like, for example, you're not hiring a hygienist or an assistant. You're just running an independent business on your own. So you can also deduct your expenses against your income. Even for those of you that just got a position recently and you want to know what can I write off, here's a quick summary. So you're going to have your collections, obviously. So that's the top line. What did you collect? So let's say you start working in July and you work July, August, all the way to December. All you have to do is calculate how much did you collect. That's the first number. That's your income. Then you got to look at all your different expenses. So here's a quick list. So advertising and promotion, probably not something that you'll have too much of, but some of you may be possibly advertising your services at the clinic that you're in, and you may incur some costs, and you can deduct that. Meals and entertainment. So for example, if you're going to a spring meeting or you're going to a conference and you're incurring a meal cost, you could deduct that meal. If you have an insurance, if you, for example, have a loan with the bank and you have life insurance and the bank requires that life insurance to be used as collateral for that bank loan, then you can deduct the insurance. Bank charges, interest, credit card charges that you're incurring, you can deduct those if they're related to your business. Fees, licensing, dues, memberships, Ontario Dental Association, Royal College of Dental Surgeons of Ontario, Canadian Dental Association, any of those memberships that you're a part of, they can all be deducted against your income. And this is just a list of things that you need to keep track of. We provide our clients with an Excel spreadsheet, and when you're running as an associate, you just kind of sort of calculate the total for the year. And based on that, it'll determine the difference, again, between your income and your expenses, which determine your taxable income for purposes of calculation of your income taxes. And what will happen is we'll take that information, including your automobile, for those of you that are working at, for example, multiple clinics. So let's say you're one day you're going to Oakville, and the next day you're going to the other side of the city, into Oshawa. So you're in two different parts of the city, and let's say you live downtown, you're driving back and forth to your different projects. You need to keep track of your travel expenses, because you can deduct those against your income because you're classified as a business owner. And there's different rules and regulations in the Income Tax Act that enable you to deduct certain expenses, including meals and entertainment, travel, supplies, etc. So these expenses need to be tracked. And if you are ever asked to provide any supporting documentation for your expenses, you can simply create a log or keep a log. And a lot of people will have an app on their phone, and or they'll keep track of a ledger in their on their phone, or they'll just keep track of how many kilometers that they drove, and they'll keep their receipts for their insurance or the lease or their car, and they'll provide that at the end of the year when they do their taxes. So some of the other expenses, For those of you that are using a portion from your home as an office, there are provisions in the Income Tax Act that allow you to deduct those a certain portion of those, depending on what type of work that you're doing at home, and what percentage of your duties are there. A lot of dentists will they'll be providing they'll be doing for example research, or these days they can log in directly to the practice management software at their clinic and prepare for the next day's treatments, or they can review x-rays at home. Or some people are actively looking to buy or start a dental practice, and during their time when they're at home, they're actually advancing their business plan, and they're doing things that are part of their business, and they're trying to develop their business. So keep track of these expenses. This is just a quick list. Next section is tax-free savings account. So for those of you that are interested in investing and you have surplus funds, the tax-free savings account is something that started back in 2009 and allowed people to contribute money into a fund that the government registers. And basically what it allows you to do is accumulate funds in the account without paying tax on any growth. So for example, if you were, like right now, the maximum amount that you can put into this TFSA, short for tax-free savings account, is $69,500. So if you put, and that number is based on your age. So if you were 18 years old in 2009, and then every year the government would automatically add certain limits prescribed in the Income Tax Act to that accumulated balance to enable you to contribute that amount. So the maximum amount that you can contribute into a tax-free savings account is $69,500. So if you take that money, for example, and put it into a simple example is like a GIC or a term deposit, or even a stock, a bond, or a mutual fund, and you earn interest, dividends, capital gains, or royalties on that investment, there's no tax on that growth. So it's a gift from the Canadian government that was a byproduct of the last recession, where Jim Flaherty, who was a Minister of Finance at the time, they had come up with this concept to help Canadians save. And it's definitely something to look at for those of you that may have already been associating for a while and you're saving some money on the personal side and you want to earn some return on it, but you don't want to pay tax on it. You can just simply walk into a financial institution, open up a tax-free savings account, contribute the funds into the tax-free savings account, and you don't have to pay tax or report the interest or dividends or capital gains. So it's a great way to accumulate return without paying tax. The other vehicle is the registered retirement savings plan. So that is something that's the contribution room is not something that's increases every year regardless of your income. This one actually increases based on your income. So if you're, and it's 18% of your earned income. So your earned income is basically salaries and self-employment income. So if you're working as a sole proprietor and you're or working as an employee, even if you were working part-time while you're in school, you would have accumulated some RRSP room. Now the difference between a TFSA and an RSP is an RSP, when you make the contribution, you actually get a deduction on your tax return against your taxes, whereas a TFSA, you do not. The other difference is when you deposit money into an RRSP, you are you're getting a deduction, but when you remove the money from the RSP or withdraw the money from the RSP, you have to include that amount back into your income. So first thing to do, what we suggest is go to the Canada Revenue Agency website and sign in and register for My Account. My Account is basically an online portal where you can find out what is your RSP room, what is your TFSA room, what is your, going back to the other thing about the tuition, make sure all your tuition's been logged for all the years that you've been studying, because the government doesn't automatically log that stuff in. You actually had to have filed your tax return and log that stuff in. So you want to make sure you go in to this free portal that's available to the government, by the government, and log in and see if all these things are in place. What's your RSP room contribution room? Because if you're working part-time, for example, in in school, you would have maybe accumulated some RSP room. A lot of people were working for family members when they were younger, and they've actually have some RSP room built up, and they can use that as a tax shelter when they prepare, when they do their tax return for 2020. And the same thing with the TFSA. Just for your own personal knowledge, find out how much room you have, so that you can use that as a planning point. And the best way to do that is to register at my account at the Canada Revenue Agency website and get access to your own account, so you can see which tax returns are filed and all your stuff is up to date. That leads us into the home buyers plan. So the home buyers plan is a plan that's available for individuals that are purchasing their first home. And basically what it allows you to do is, when you make that RSP contribution, you can, when you pull the money out of the RSP, it gets taxed on your personal return. However, if it's for the purchase of a home, the down payment, the withdrawal does not get included in your tax return. It gets tagged as what they call a home buyer's plan. And when you go to the financial institution and you say, well, I'd like to withdraw this money from my RRSP because I'm purchasing a home, you can withdraw up to $35,000. And if you're married, you can both take out $35,000 each. So that's $70,000 that you've already gotten the advantage of, because you've taken the deduction from the RSP. Now you're taking it out of the RSP to make a down payment on your home, and you're not getting taxed on the withdrawal. The only caveat is you have to return that money back into the RSP over a 15-year period. And the government's going to keep track of all that stuff. So definitely something to consider for those of you who are just getting back into the job market. They just graduated and you're associating, and you're thinking about maybe getting a place. And those of you that have been associating for a while and want to look at your RSP contribution room, see if you've made an RSP contribution. If you haven't, $35,000 is a good magic number to just get started. It's not going to be a huge dent in your mortgage, because the average housing prices in Canada are about $500,000, a lot higher in the GTA, but it gives you some relief on the tax savings on the one side, and then you don't get hit with the taxation of the RSP withdrawal, because it's structured as a home buyer's plan. One of the things to watch out for is just make sure that there's some limits on the amount of money. The money has to be contributed within a certain number of days, approximately 90 days in the plan before you withdraw it. So if you're closing on a transaction and you go, I need to make an RSP contribution, and then you withdraw it right away, it won't qualify. It also has to be a first-time home buyer, generally, unless in some cases where people have bought a house, let's say 5 or 6 years ago, and then they sold it, and then there's been a gap of time of over 4 years, they may be eligible to go ahead and be qualified again as a first-time home buyer. So depending on your circumstances, something to definitely look into. Another area that we see a lot of is the first-time home buyer's amount. So this is actually a tax credit, similar to the tuition credit, where you get like a little bit of a relief on your taxes. And it's a $5,000 credit that you get, which is basically equates to about a $750 refund back in your taxes, just for disclosing that you purchased a home. So simply all you have to do is when you file your return, you just have to indicate the address of the property, the date of the purchase, and you automatically get eligible for a $5,000 home buyer's amount credit, which equates to about a $750 back in your pocket. So that's definitely something to look into for those of you that are maybe considering purchasing a property in 2020 and 2021. And for those of you who may have already bought a property in the past, and if you didn't claim the amount, a lot of times it gets missed. You might want to go back and check your tax return and make sure that you can file an amendment and get that $750 back. So item number 11, how much income can I expect to make after graduation? So this is a quick chart. We've presented this a few times to when we go out to U of T and Western, and which are the two dental schools in Ontario. And this is a quick summary. Like the first 1 to 3 years as an associate, get anywhere from $75,000 to $300,000. It's a big range. Really depends on where you're working, how frequently you're working, if there's any specializations potentially, or how advanced your skills are and how fast you are, can dictate essentially how much you can make. After that, there's a bigger range 3 to 5 years in, because as people start buying a practice or starting a practice or getting more hours, their income can exponentially increase from anywhere from $150,000 to $750,000 per year. And it really depends on the nature of the business that they're buying, the type of specialization that they're in. And then after that, 5 to 10 years in, we see various different scenarios, multiple practice scenarios, people having multiple practices in different jurisdictions, where they're multiplying on their on the resources available to them, and their income can be anywhere from $250,000 a year to $2.5 million a year. Sky's the limit. It's really just depends on how where you want to take your career, and how ambitious you are, really, in terms of developing a network of dental offices in your portfolio, or if you just want to have one office, or you just want to be an associate. So there is definitely flexibility in the different career paths. So next question: when should I start looking for a practice to buy or start up? So this is a question that comes up a lot, because a lot of times people start associating right away, and a lot of times people want to start right away, and they want to start looking for buy a practice, and that's okay, because you want to get the information. You want to find out, how does it work, what's out there, what do the practices look like, how much do they cost, and the best thing to do is get the information. There's a lot of companies out there that provide listings of dental practices for sale. So it's great if you can register with these companies, find out how they work, get access to some practices for sale, start investigating some, just to get some research, find out how the financing works. You can contact all the banks and find out they have healthcare divisions. Our office works closely with all the large financial institutions in their healthcare areas, and have a small finance platform just for startups and purchases of dental practices. You want to keep on all that kind of stuff. And location is huge. Where do you want to buy this practice? And that information can be obtained from your registrar, and even from the Ontario Dental Association, or depending on what province you're in. For example, the Ontario Dental Association has a report that you can obtain, where you provide them with 3 postal codes, and those postal codes, 3 postal codes at a time. And for each postal code, they'll tell you various demographic information about the dentist in that area, the demographics of that area. And here's just an example. So here's one for the Oakville area, the western part of the Greater Toronto area. And it's got, you put in the postal code, and it tells you the number of dentists in each postal code, how many males and female dentists there are, how many years they've been in practice, the estimated population of that area, how many people there are for each dentist in that area. So you can see here, this one postal code, there's 992 people for every dentist, but in this other postal code, there's 1,988 people for every dentist. So this can also help you in your job search, because you might want to do some research when you're investigating different community boundaries, and find out what's happening in that area, and whether that dental office is in an area where there's a growing demand for dentists, or there's too many dentists, and because that could affect your hours. The other thing is, if you're buying a practice or starting a practice, this information is very valuable in researching that particular jurisdiction and determining if that location meets your requirements. And the Ontario Dental Association provides this information for free. Well, I think they have 2 different reports. One's free, and one's about $70, and it provides you a little bit more data. But it gives you a great introduction to that particular location. Gives you demographics of the population, even gives you the ages of the different individuals, residents in that area, and it gives you a breakdown of what percentage of them are under 24, or between 25 and 64 years old, 65. And that can also change your decision, because if it's obviously if you like working with children, for example, it'd be great if there's younger families in the area. If you like doing more complex work in terms of surgeries, and there's more implant work. Maybe you're looking at an older generation, older population. So you might look for an area where there's older people, more older people. So it's an interesting information and help guide your decision on what you're trying to. And they even hear private household incomes in that area, and labor force by occupation. So you can also look at, how many people are working in different trades in that area, which could help, cross-reference your decision making depending on what decision you're trying to make: buy a practice, sell a practice, find an associate position. All those decisions are important, but the information that you get from the demographics and the statistics in that area could help finalize and crystallize your decision. Now, if you're looking to buy a practice, which is also a common trend in associates, they start working and then they're like, I want to buy a practice or something. There's a few tips here on things you need to look at when you're investigating that purchase, because it's a huge decision and it's a lot of money involved. And you got to look at doing your due diligence, looking at the cash flow that's being generated from that office. With all this stuff going on with the great lockdown and the pandemic and the COVID-19, the risks have increased in terms of understanding the dynamics of the buy and the buy of the practice, and knowing how things have changed. Because a lot of the statistical data that's available in these practices for sale is historical information. So it doesn't necessarily provide you with the best path to what's going to happen in the future because of the circumstantial changes in the cost of running a practice, and along with the labor of the practice, where some people have had issues where hygienists, for example, or assistants are, maybe they're not available. So you got to look at the information that you're getting for that practice for sale, for example, and you got to attack it and evaluate it and make sure that there's no threats in that information, that threats in terms of weaknesses that weren't necessarily there pre-COVID. So it could also be an opportunity, but you got to make sure you do your due diligence, take a deeper look into the numbers. Is it a buyer's market? I mean, recently we have seen a few changes in the way that buyers are approaching transactions. For example, there's more negotiations happening in terms of the timing of the closing of the sale and certain conditions that have to be met before meeting that criteria. Also, offices that were distressed, or secondary, third offices that somebody tried to open up. We're seeing cases where a lot of times those are now just kind of going back on the market, and the sellers are just trying to liquidate them, and that's creating a buying opportunity for some buyers. But it's also in an environment that has increased risks, because there's a lot of uncertainty built into the economic aspect of this, and that has to be measured in your decision. Survival demonstrates strength in goodwill. Well, that's the other thing about the situation that we're in. If an office is hurting right now because they're closed, or they haven't opened all the way, or they're reopening, and the PPE and all that stuff, there's a possibility that as things get better and we recover out of the pandemic, that if they recover and then they go back to their pre-COVID levels, they can come back and say, look, our practice is stronger now, because it demonstrates how strong a value of business is, because we were able to maintain the charts, maintain the relationships, maintain the goodwill. And that's another area that needs to be considered in the decision, in the timing on when to buy, because that timing of the production being low right now could be a vulnerability for the seller, and the buyer could take advantage of that. And that being said, a lot of sellers have taken their practices off the market right now because they didn't want to take the reduction in the valuations, and they'd rather just wait it out and then build the practice back up and then list it again. So the other thing to look into is financing. Financing is still available. The banks are still out there lending, but it may become a little bit more difficult. You may have to do a little bit more work with the seller to demonstrate what the business plan is. So these things need to be considered in the process. So that's it for me. Thank you everyone for having me here. Reach out. Here's my email address. It's been they're turbulent times, but thank you everyone. If anyone wants to reach out for private consults, let me know. You can send an email, give me a call. We're open for business and we're happy to help out the community. We're looking out for some more future seminars that we're doing, to market updates, and we'll keep communicating with you through our LinkedIn and our Facebook page. And if there's any questions, I'm not sure if there are any, but I can check quickly here on the Q&A. That looks okay. Yeah. Let me see. Presenters. Yeah. Okay. If anyone has any questions now, you can post it in the chat section. If not, just reach out. And what I'll do is, if there's any questions that are posted here that aren't, let's see. No, I think there's a question here. If a dentist joins 2 corporations, does she double the taxes? Okay, well, I guess it depends on the income that's generated from those 2 corporations. If those 2 corporations combine together, you have to manage the income tax rate that's being the level of income that you're at. A little bit earlier, I talked about if the corporation's income, and that's after the expenses, goes over $500,000, then the tax rate also increases from approximately 12.2% to 26.5%. So there is an increase in the incremental tax that's being charged if you combine the 2 companies. As long as you're under the $500,000, there isn't a major increase in taxation. Let me just see here. I think that's it. If anyone else has any questions, please reach out, and we'll go from there. Otherwise, thank you everyone for having me, and look forward to our next session.